Welcome to the Best of U.S. Investors Platinum Channel Week in Review. It's December 2nd, and in this video, we're going to talk about the passing of a legend, along with some economic news, retail sales, ISM numbers, and the potential for the Treasury yields going higher, and along with some crazy stuff from that reminds us of a lot of the great financial crisis, and that is selling bad debt to the retail investor. So stay tuned. This past week, a legend in the investment world, Charlie Munger, passed away at age 99. He is the partner of Berkshire Hathaway's Warren Buffett. He is the out of the camera guy, but with incredible knowledge and incredible value that he brought to Berkshire, and his legendary partnership with Warren Buffett will be very missed. So let's check out a couple thoughts from Mark from this Friday's Platinum Channel call about Charlie Munger.
Probably heard. So I don't know if you guys have ever, I've been a Berkshire shareholder for a long time, and I go to as many meetings as I can. And it's so interesting to hear Warren and Charlie. And as old as Charlie was, he was sharp as a tack. And he was so much fun to watch those two go back and forth and just be open and honest about, you know, they're not one of these guys that sits up there and tries to dazzle you with, brilliance. They just tell it how it is. And Charlie Munger was one of those guys. And I was really sad when he passed, because I always enjoyed going and listening to him, and that was just one of the highlights of the meeting for me. So just wanted to give him a little perk here, because I think he's one of the greats that came out of it, and he's from Omaha, so I got to give him that.
So let's hit upon a couple news items that hit the wire this past week. One, the Federal Reserve Chairman Powell came out and said he has no plans to lower rates anytime soon, yet the market is pricing in that next year we will see 3 to 4 federal fund rate cuts, along with because of a slowing economy. Yet when the Fed comes out and says, no, we're not, because of rising costs and inflation, you got to wonder who is telling the truth. Maybe the guy who's actually controlling the needle on interest rates. Maybe. Who knows? The other element that thing came out was last week after Thanksgiving Day, Friday's big holiday sale, Black Friday, and then Cyber Monday. We saw a big jump, or not a super big jump, but like a 7% increase over last year's sales numbers because of something they don't count, and that's inflation. Inflation has gone up year over year. And of course, the amount of sales that have been made on Black Friday and Cyber Monday were heavily increased because the cost to buy those same products a year ago has gone up, which would move the needle when it came to the amount of sales that has been reported. The other big thing that I think needs to be taken notice, and Mark talks about this in the Platinum Channel on Friday's call, is that the number of pay now, pay later loans that came in or happened last week was up 29% year over year. So what this is telling us is that now that credit card delinquencies are through the roof, check out the chart that I'm just posting here, but also people are running out of limits, room on their credit cards, and now they're going to these pay now, pay later programs where you basically are borrowing money again to buy something for today. What this tells me about the consumer is they're weak. They're hurting right now. They're financially strapped. The cost of inflation is gouging them. They've maxed out their credit cards. They've spent down their savings accounts that they built up during the pandemic. And now they're going to the next level of borrowing and going into debt. And that is pay now or buy now and pay later. Where this is truly going to come out is next year when it comes to having to pay those credit cards off and pay those balances off and paying off those pay now, pay later loans. How many defaults are we going to see? How much delinquency rate increase in delinquency rates are we going to see? That's what I'm checking out. The other thing that came out was the manufacturing PMI. For the 13th consecutive week, it has been below 50. Now, if you don't know much about the manufacturing PMI, it's put out there by ISM, and basically what it says is at 50 or above, you're basically even at this point. Anything below 50 in manufacturing is a sign that the market, the manufacturing market, is greatly slowing. It reported at about 46.7, which was didn't change in the month of November. But what this is telling us, this move from 49 to 46.7 over the recent period, and Robert points this out because he's a business owner and he's on the call with us. He's a platinum member. And he pointed out, he says, any move from like 49 to 46, that is a major rate of change when it comes to manufacturing. He even pointed out as well as this has been going on since January. He saw this in his business. He's in the nut, bolt, and washer business. And so he ships and sells, all over the world. And he started to see this decline in manufacturing, the decline in these kind of products that he sells, which is heavily manufacturing oriented. And he's starting to see this, and this is only coming to the surface now because it's a trailing indicator. So what should we expect for manufacturing going into the new year? Probably a bigger decline in the amount of manufacturing PMI. So that is a caution and an indicator that we are entering a recessionary environment. All right, so Mark gets into treasury yields. Now, treasuries, if you don't know, is how the U.S. government raises money. So he gets into how the U.S. 10-year the yield has gone down, which has lowered mortgage rates here recently. But at some point, the United States is going to have to increase that 10-year offering yield to make it more attractive to auction off those bonds, instead of people going, if you get 4.22 or so percent in a 10-year treasury, but you can go invest in the stock market and get way more, you're going to put your money in that stock market. So the U.S. government is now battling that. So let's listen to Mark as he gets into the U.S. Treasury and what it's doing.
Again, yields are going down. And so, I can see it even in the short-term treasury bills, where we were up, above 5.5. Now we're about 5.3, 5.35. So it's coming down a little, but she's still going to have to pay us money because the government is in so much debt. They got to pay off the debt and they got to pay off the interest, which is over $1 trillion. So those treasury bills, she's got to have to compete with the stock market. If the stock market goes up, money flows out into the stock market and out of the treasuries, and the government needs those treasuries because that's what's paying the bills right now. But one of the things that, and I brought this out in the blog earlier this week, and it's on the under 200 stock list, is TLT, which is the iShares 20-year Treasury bond. And you can see how as yields go down, the price of treasuries are going up. So again, we right up, it's hitting right up here where the sells are, but we'll see if it can continue this trend up. Here's your 200 up here, but we're above the MACD. We're above, on the stochastic. The RSI is strong. This is just a nice little slow trender up, that could go for a while. Let's back out just a little bit for a year, and you can see what the prices as yields have gone down or up. The prices have gone down, and now we're starting to see that reverse a little bit. So there's always money flowing somewhere, and it's a weird thing. A lot of people don't understand treasuries. How can yield go down and price go up? Well, that's what happens. And during the great financial crisis, a lot of people made a lot of money getting into things like the long-term end of the treasury bond, like the TLTs. So just keep that on your radar. It's not exciting, but I don't care about excitement. What I care about is making money and not losing money.
So back in 2007, 2009, we saw a lot of bad bonds. And they were basically loans, mortgage loans that were basically badly rated mortgage loans, and they would package them all up into bonds. And when they did that, they would then turn around and sell that bond out to the consumer or to hedge funds or other institutions. Well, what a lot of people didn't know was a lot of those mortgages that were within those bonds were really bad mortgages. They were like so bad credit wise. And that's what really created this exponential blow up during the financial crisis. Now, people then created synthetic or what I would call options or contracts on top of those bad bonds in anticipation that they would go up or down in value. And that's really what basically blew up, created the financial crisis. So you got a bond, you got a bank or a Goldman Sachs or JP Morgan Chase. They take all of their mortgage-backed loans and they look at it and go, there's a high degree of default in these. We're going to package this risk up and we're going to put a handful of good credit loans at the top of the basically top of the heap, and then everything below it is going to decline in credit risk or increase in credit risk, meaning the delinquency rate is going to go higher. So they package it up and they sell them, right? And then of course Wall Street creates a synthetic product that bets on that bet, and so on, and that created the great financial crisis in essence. Well, today, now we're seeing that over the next year, we should see basically $100 billion of high risk loans that are in sort of the credit card market, in the auto loan market, and even in the mortgage market that are now being packaged up as a asset that pays out anywhere between 8 and 15%. And companies like JP Morgan Chase, Indiana, Merchant Bank of Indiana, and a couple others have basically started doing this. And the reason they're doing this is because they see an enormous amount of risk of default when it comes to the loans that they have made. And so to hedge that off, they're basically taking that, packaging those loans up into a note, and then they're selling it off to hedge funds and institutions and possibly even consumers, with the possibility that they will default at some point. Now, the bank who issues it takes the first 1% in loss, but then the buyer of that risk asset takes on the rest of the risk of that loss. So there could be an enormous amount of risk that could blow up. And Mark talks about this on the Platinum channel, and let's have him dive into it a little bit and hear a little bit of the commentary about that.
I have one more story, and then I want to get to a couple charts. But this one was interesting, and I don't know that too many people saw it. And I put it in the Discord. It's called credit risk transfers. Does anyone know what that is? So anyway, the big banks and all banks have all this liabilities. They have liabilities on their balance sheets, and they're trying to get rid of them. So this story came out and said U.S. banks expect to sell the risk on nearly 100 billion of assets, the risk of that, in the next 12 months, freeing up nearly 15 billion of equity capital. Investor gets yields ranging from 8 to 15%. So investors are willing to pay 8 to 15% to buy up risk from banks. Okay, and this is starting to sound really familiar to me for those of you who were around in 2008. With the things that happened there over the past few months. Banks including JP Morgan Chase, Merchants Bank of Indiana, and U.S. Bank Corp have sold risk of losses on billions of dollars of loans for cars, multifamily homes, private funds, junk-rated companies, commercial equipment, and consumers. Merchants Bank of Indiana priced in 158.14 million credit-linked notes on March 24th providing credit protection on some commercial mortgages, including loans to nursing and assisted living facilities that deal terms show. The transaction freed up merchants' capital, allowing it to use it to make new loans. So they're setting they're putting their risk into tranches and selling it to investors, kind of like what I saw in the housing market. And they're taking that money that frees up and they're making more loans.
So it's not insurance they're selling. They're selling, they're just packaging up bad, high risk loans.
They're debt.
They're dead and selling off as basically junk bonds.
Yeah.
Sounds like the OE short.
Yeah, I mean, so it just that's
Exactly.
those are the kind of stories that was on Reuters. So it wasn't like it was hidden, on Zero Hedge or something. That was on Reuters.
So Mark points out this week that when you look at it, the three indices that most people watch, which is the S&P 500, the triple Qs, which is the NASDAQ 100, and the Dow Jones Industrial Average, over the last 9 days, these indices have basically gone sideways. And yet people are like screaming like, oh, the market's great, everything's fantastic, all this kind of thing. And so as he points out, over the last 9 days, these indices basically have gone sideways. And he breaks that down. But the other thing he points out in here is the gaps that the month of November created in these indices. And if you know much about gaps or don't know much about gaps, this is when the price jumps from one point to the other, and it's a gap, and it usually is over a 1 day period. So let's say the S&P went from 4,300 to 4350, which is a big jump in 1 day. That would be a gap. And Mark shows you those gaps in this next segment of the video. And I think this is really important to check out and look for, because as you see, we're plateauing when it comes to the indices. Yet we have these gaps that were created in the month of November, and eventually all gaps get filled at some point in time in the future. Now that could be in a day, in a week, a month, or a year. It doesn't really matter, but at some point they typically get filled. And that means if there's a gap up, there is then a move down to fill that gap. And if there's a gap down, typically that gap down is filled by a move up in that stock or indices. So let's let Mark break this down and check this out.
They give us the impression that the markets are going up and going up and going up. But I look at the charts and I'm like, they're not really going up. They're going sideways. Okay. Now here's our intermediate resistance. And today on the SPY, we're trading just above it, but we'll see if we can maintain that and keep going up. But right now you can see we've been going sideways for 1, 2, 3, 4, 5, 6, 7, 8, 9 days, basically. We still have a 9 day was kind of curving over until today. We have a MACD that's getting very close to the signal line. We're still riding high on the stochastic. You can see how long these stochastics, these RSIs can ride, because you'll see a lot of people, they'll say, oh, yeah, this tells us that, you're overbought. Okay. Well, this can go for a long time because it has a ceiling. And once it hits the ceiling, it stays there. They can't go any higher. That's the ceiling until it doesn't. And then it comes down. So again, we're still seeing a little bit of a curve over on the SPY. And the other things you want to know, these white boxes, these are gaps. These gaps came up in November, and they're big gaps. Okay. So when these fall, and they will probably fill the gaps at some point, these are like coming down and hitting, when you're jumping off a building and you're hitting different floors, and then all of a sudden there's no concrete, and then you fall to the next one. I mean, it's just, it can fall really quick. So it'll be interesting. Let's go look at the Qs, which is the NASDAQ. And I see the same thing. So see, we've been over resistance. This resistance line is hard to get over. We've been over it, but look at the 9. The 9 is not, rocketing up anymore. Look how close it is to resistance. And it's still price is trying to squeeze in between there. It's either going to pop up or down. And I'm looking down here saying, I'm looking at the Qs pop down is what I'm seeing. I'm seeing a converging Bollinger Band, and I'm also seeing gaps right under price action. Here's a big gap. There's another gap. So just be careful out there because the charts, charts don't lie. They don't have any feelings, they don't have any skin in the game. They're just the charts. Let's look at the DIA, which is the Dow. The Dow was interesting. This Dow keeps stair-stepping up, up, and now here we are still on the upward bound. And it came up, and the upper level resistance is now above my chart. These are where the sells are. You can see it hit right on where the sells are and stop there. But again, we're up 0.76% in the Dow. This
Mark?
one's still, yeah, go ahead.
No, go ahead, finish up, and I'll ask you a question.
Well, the reason the Dow went up yesterday is because, oh God, who was it? Salesforce and a health company had good earnings. And when Salesforce went up, there's only 30 stocks in the Dow. It can really affect the Dow, and so that's why you're seeing the Dow go up, and you're seeing the S&P and the Qs, which have a lot of the same stocks, go sideways.
So each week on the Friday Platinum Channel Swing Trading Call, Mark gets into the list. So there's the watch list, which is meets all the criteria Mark has for the swing trading program, along with then the Horizons list, which meets most of it. And then there's the below 200-day moving average list, which a lot of criteria isn't being met, but some is. And so they go down in risk level. So when it comes to the watch list, that's your least risky, your Horizons list, that's your second riskiest, and then the below the 200-day moving average list is the most risky. And so this week, like every week we do, we break down some of the trades in the charts. We get some commentary from a couple other participants who are part of the tribe. And so let's go to that and hear some of this, because this was actually a really good week. And Mark points that out on the watch list and how we did for the month of November.
Trading portfolio. So we didn't have that many trades this month. And in November, I mean, the market went up, but it wasn't like we had a bunch of setups. It was like the stocks that went up, it took us up, where the Mag 7s took us up. And so trying to go and pick in between the Mag 7s and see who's going to go up was harder. So we didn't have that many trades. But what I wanted to show you is we only had 9 trades. Of the 9 trades, 2 of them went bad, but when you set your limits, you get out early, you don't lose that much. Okay. Our biggest one was we're down 3.1% here, and we're down less than 1% on Centene. But we had 9 trades. But out of those 9 trades, our gain was $4,651 had you traded 100 shares of each on this. Again, this is all paper trading. And you take out the $60, for the deal, you made, well, that added it. So anyway, that shouldn't be that. I'm not very good on Excel, but anyway, $4,600 in 9 trades. So that gave us about, 78% win rate. So you don't need to do a lot of trades, and most people, like Trent said, his friend does like 1 trade a day or whatever, or 1 trade a week, and goes fishing. And so it doesn't take much. You just got to be strategic in how you do it. You got to set your limits. You got to make sure on the downside, you limit your risk on the downside, and on the upside, you let it go as far as your risk tolerance can take it, and get out. No hopium, no psychology. You just watch the charts and you watch the resistance and support lines. And again, this was a small amount of trades, but it got us a large amount of potential paper trade profits. Stocks below the 200. Okay, it's been an interesting week, because these stocks, I don't, and again, just because something's on these lists doesn't mean you should go trade them. It just shows that, these have an opportunity to be something bigger, or they have an opportunity to lose. And when you look at, below the 200, we had a lot of stuff on the list, and we had a lot of losses. And these are just between support and resistance, basically. But you can see we had some wins, we had some losses, and out of the total, we're up about $249 or $249 a share. So I hope that people don't go in here and say, okay, I'm going to buy all these, without going through and figuring out why we're buying them or when we're going to get out. We had some good winners. This one here just surprised me. This Mr. Car Wash, out of nowhere, it made us $106 in 2 weeks. Spirit Airlines, $155, biotech, made some cash. Let's go look at Mr. Car Wash. Real, I get so excited, Paul, especially on Mr. Car Wash. So here's a one. This is manual I put in. We bought way back here when it went over the 50 and then kept going. Okay, and then it zipped up here and it hit a resistance line. And again, these resistance lines move. It could have been, so it was either resistance or it probably hit the upper Bollinger, if I remember right. And that's where I got out when it hit the Bollinger. Stocks trade normally on average outside of the Bollinger Band, maybe 5% of the time. So if it gets outside of the Bollinger, it's probably going to pull back in. So anyway, then to Paul's point, it went sideways. Okay, so that was a good point to get out as far as I'm concerned. Now we have the sells up here, and today you can see it's popped up 5%, but it hit the sells. Okay, but I'm still not convinced with this 9 kind of flattening out. We're seeing the Bollinger Bands kind of coming together. I'm not sure it's going to get over this 200 either. So I got a MACD crossing over. I'm glad to get out to take the money. I'm risk averse. Someone else could have stayed in, perfectly stayed in. But anyway, Mr. Car Wash did a lot of fun for us this week.
That was a nice one.
Hey, Mark, can you
Yeah.
pull up BCRX?
BCRX.
I like that one.
Yeah, this is one that I got in at $5.30 at the beginning of the week and put my stop at about 2% below. And by Tuesday was stopped out of it. I didn't come back to it just because of just the world going on and busy. But now I see where it's at and I'm like, did I put my stop too close?
Yeah.
And should I have said, okay, now if it comes back above 530, reinitiate the trade?
That's really a personal deal that you want to look at. I look at this, I'm like, we're going sideways and we're popping between support and resistance, and you have an intermediate support level right here. And then you've got the 9 right below it. And then it started popping up. But before that, you're just kind of going sideways and you're playing a really small stock for, it goes up 15 cents and it's up, 2.5%.
Right.
So then it popped up yesterday and hit a resistance at 50. So now you're thinking, okay, do I wait the next day and catch it if it goes down and starts playing between the 20 and the 50? And so today, if you would have went in and just said, okay, I'm going to set my limit a little lower to see if I can catch this on a down, you might have caught it on this little tail down, and then you'd be up again. But look where you are.
Yeah.
You're stuck right here where the sells are. And then you got a Bollinger Band right here, So unless I see something different, I mean, you still got a good strong MACD. It's going to have to pop up over this Bollinger to keep it rolling up,
Yeah. That was.
But you made a profit, and always be happy with a profit and never look back and say, oh crap, because that's what's going to kill you in the end. You're going to sometime in the future, you're going to say, well, last time I did this and I didn't follow my trading plan and now
This
I'm down
one,
20%.
This one I lost 2% on, but I bought APLD on Monday as well at 466 and I sold it at 490.
Now,
like
what was
on
the symbol on that? I forgot what we had.
APLD.
Oh, APLD.
I made money on that one.
Yeah. So I ended up putting a order in at 490, and I bought it at 466. I sold it out at 490, and I think today it was up around 5.
Yeah, I sold out at 504 today.
You did.
Look at where it's at. I mean, it's this intermediate resistance line right here.
Yeah.
Is at 494. So you guys, it popped up a little and it hit the next resistance at the 50 at 502 and went a little higher. So you guys did good because it's probably going to keep playing unless it can break over this for a while. It's going to keep playing in that area. So
yeah,
be happy with what you got. Start, learn these lines. I mean, look at this. Okay, we still have a nice 9. That's short-term moving average moving up. We still have a MACD moving up, but these resistance lines, especially intermediate resistance, they're just hard to get over, And
Yeah.
then right here you got a 50 right next to it. So it's like having 2 big linebackers in your way, and you're a little skinny running back, and you look up and you got 2 linebackers, and you're trying to make it to the end zone, which is up here, at the 200, and
Right.
you just might not make it. So yeah, those were good trades.
Yeah, I'm definitely
All
one. I think the one thing that was very much a challenge, and you've taught me this, is take the losses fast. And when I put a 2% stop on that BR or BCRX, and I got stopped out, I was like, oh, I should have waited. And then I was like, no, quit thinking, go back to work, let it play out. So
finally, we're at the end of our video today, and I want to just reiterate a couple things that were said on the call this past Friday. One, Mark says, protect your downside risk and your upside return will take care of itself. If you minimize your downside risk in investing, in swing trading, or just in life in general, your upside return will become exponentially bigger. And so managing your risk and being aware of where the bottom side is and how much loss you can absorb over a period of time is essential. And second, Paul pointed this out about the Platinum Swing Trading channel. Now, it's a pay for service. You get a whole lot of stuff. If you have any questions, you can always send me an email at support@bestofusinvestors.com. That's support@bestofusinvestors.com about a breakdown of everything that's involved, and I can give you nitty gritty and all that. But Paul said it best, and I think this is a great statement, a great quote, just in general for life. And that is, it's just fun. We're just having a lot of fun investing and learning and doing things with a community who is all moving in the same direction. So I encourage you to become a better investor. This isn't day trading. What we're teaching is lifelong lessons for you to create wealth and protect your wealth. So hit the subscribe button, hit the like button on my YouTube page here, and check us out at www.bestofusinvestors and check out the Platinum channel. I look forward to seeing you next week, and have a great week and happy holidays.